So I'm gonna bring Kiana on, and we're gonna talk about this. And if you have any questions, put them in the comment box. We can answer them right here, right now, live. Okay? Hey, Kiana.
Hello, good afternoon.
How are you?
I'm good.
So what's going on? We're talking about DTI, and should I buy a car first, or should I buy a house first?
Yes. Oh, please, we got to talk about this. How many times do we have people do the wrong thing and then can't help them after that?
But listen, that new Escalade look nice. I think the house could wait.
You want to park it in front of your apartment?
It's kind of big. I can't sleep in the back.
That's where you will be if you do it wrong.
So what's going on? We're going to talk about our numbers.
Yes. So we're gonna do a sample so people can see the actual difference. You can tell people, but they gotta see it to really understand the difference. And even how we even calculate debt to income ratio in the first place. That's the first thing.
I don't know that per se. I let you guys do the numbers.
Yes.
But I know enough to say you can't have too much credit card debt.
Yes.
You can't have high school loans and a car. I know it affects. I know that much. I don't know back end, front end, things of that nature, but I'm sure you can explain it a lot more.
Yeah. So the first thing a lot of people don't understand is what is debt, what counts as debt. So a lot of times if I say what's your debt, some people may think, oh, I don't have anything in bad standing. I pay all my bills. So first of all, debt is not necessarily a negative. I don't mean what are you delinquent on? That's a difference. Delinquent and debt. Debt just means you owe somebody something. You can be making the payment on time, but it still will be debt. So that's the first important thing.
As soon as against when you get the mortgage, right?
Right. So it just it factors in. So it's not necessarily a negative. You don't want to have too much debt, but just saying debt in and of itself is not. I don't mean are you delinquent. I mean, do you have a car loan? Do you have student loans? Do you have a line of credit? Do you have credit cards? Those things count as debt. What doesn't count as debt is like rent, um, car insurance, things of that nature do not count as debt. Debt is something you can't just stop. Like if your car insurance, if you say tomorrow, I don't want my car to be covered anymore, you just stop it. But the car payment, you can't just be like, hey, I'm done with this car, thanks. No, you still owe that car payment. So if that helps to explain the difference between just expenses and debt. So that's the first thing that people is a misconception. And then okay, now we know what debt is. So now we're like, okay, income has to do with your qualifying income. So what does that mean, right? Because a lot of times people are like, well, I work 2 jobs, but they just picked up the second job 6 months ago.
That is a big one. Right. I have a lot of people who come to me and say, well, I work 2 jobs. I said, okay, that's fine. And right off the back, I'm always like, well, how long have you been on a job? You have 2 years. Well, I've only been working it for 6 months. I mean, money is nice that you can save it, but you're not going to be able to use that income when you purchase a home.
No, unfortunately. So qualifying meaning income that I can count based on the guidelines. So that's the main one that cannot be counted that people think can be counted is that second job they just picked up. It takes 2 full years of having 2 jobs. It doesn't have to be the same 2 jobs, but you have to have had 2 jobs for 2 years before I can count both incomes. So what we end up doing is whichever one you make the most at, but not both. So that's just an example.
We're talking about qualifying income. Let's talk about child support. Did that count?
That's a debt. Yep. Oh. Sorry. No. On the income side, if you're the receiving, yes, that's the income. It can be if it's consistent. A lot of people that don't get their child support consistently, you can't count it. So that's again qualifying. They get it, but if they didn't get it consistently for at least 12 months, we can't count it.
What about SSI?
Yes, that can count. Even if it's for your kids.
I got another one. Unemployment.
No. That is not qualifying income. I wish I could yell that from the tops. That is not qualifying income. That does not count as any income. That's just helping you get to the next job, but that is not helping you buy a house.
Okay, I got another one for you. Proceeds from stock trading.
That can count, again, 2 years. So if you want to start thinking of, in general, you're looking for stuff that you've gotten consistently for 2 years. Child support, if you've gotten it consistently for a year, we can count it, but anything else is generally 2 years. So that stock income, if you report it on your taxes, so that's the first thing. 2, if it's been 2 years. So if you lost the first year, it's gonna be an average. If you lost the first year and you gained the second year, it's not gonna just be what you got the second year. They're gonna take it, add it, divide it by 2, see what you got. So, and if it's too variable, they won't count it. So it won't be qualifying.
If it's too volatile, they won't count it?
Yeah, like if you, I don't know, they might not. If you lost big time the first year and you only made that second year, they may not count that. It's a percentage, and it's up to the discretion of the underwriter.
That's interesting.
But you can, if you start, trading consistently and you're making, a couple thousand, $10,000, whatever you made for the year, they're going to give you a 1099. And if you count that, which you should be, when your tax returns, you can count it as income when you get ready to buy it at the second year.
Okay.
So that's a good one.
All right. Well, we went over a few things. Hopefully people understand what qualifying income means.
Right, and not qualifying income that doesn't qualify.
If you're working for a job and it's work under the table, that is not qualifying.
Sorry, not
Keep
at all.
the side hustle to the side.
Yeah, unfortunately, people are like, I got a check. I'm like, but if it's not a paycheck where they're taking out wages or you're not reporting it to Uncle Sam, I can't count it. It's got to be legit.
Okay, all right, moving right along.
So we got debt. We defined that a little bit. We gave some samples, and then we got income. We kind of get an understanding of qualifying income. So you got your debt to income ratio. Ratio meaning just one compared to the other. So they want to get a nice balance between how much debt you have and how much income you have. They want you to basically have income left over. And it's more significant than people think, how much money you need to have left over. They want basically, in general, you to have one on FHA is a little bit higher, but they'll allow you to go to 50%. If your credit is really good, I can push it up to up to 56%. So basically 50, that's half. People are like, what? So imagine your income, you have to have half of it basically left over to qualify. So people thinking, I can afford this and that and this and that and blah, blah, blah. And then I still got, $20 dollars left over now. At the end of the month, that's not enough. They want you to have almost half. Because what doesn't go into the calculation, like I said, is stuff like your groceries and your car insurance and all these things. So they want to leave plenty of room for all these other expenses that they don't count. Mm-hmm. So that's an important thing to understand, is that you basically have to have half your income left over. The max on conventional is 45. They will let you go to 50 if you have money left over, which is called reserve. But anyway, so I just use 50 just so people can understand. Yes, you could go a little bit higher if your credit score is higher, but generally 50, you can easily calculate that yourself. 50%, half of your monthly income is on a monthly basis that we calculate this debt to income. So we're comparing your monthly debts to your monthly income. So I guess we can start, we want to pull up over how we're, like a sample. Mm-hmm. People can kind of visually see this debt to income calculation.
So in this scenario, what's going on here?
Okay, so we're gonna do someone with a $60,000 a year income, right? So like I said, everything is calculated for the debt to income ratio on a monthly basis. So the monthly income, we're gonna divide everything by 12. So yearly income 60, monthly income 5,000. Okay, that's where we came up with that number. And so we're gonna just have some sample debts that people have. People have student loan debt. That's actually low. $25,000. I got people with 100,000. The highest I've seen was probably almost $300,000.
I have a question about student loan debt. Is there any mortgage product that help with people with very high student loan debt purchase a house?
Yes. So this is important. If we can swing them into conventional, which is a more stricter guidelines than FHA, we can and they get an income-based payment, which is important. They gotta call up and tell them this is what I make. I can only afford this, but you gotta take it out of deferment. You can't have it in deferment. You have to get an income-based payment. Now, the income-based payment may not be that high. If your income is 60,000 or lower, you might have a zero income-based payment, but you gotta take it out of deferment. Yeah, I don't understand why. It doesn't make sense to me because I'm like, how are you going to pay it off? But you can have an income-based payment that is zero.
So when do they start paying it back?
Don't ask me. I'm not a student loan expert, but I know you can do that. That much I know enough to help me. But as far as how do you pay it back? You still want to be making some payments. I would, because it's just going to pile up. But it's possible. Some people are waiting for a forgiveness program. So it may be in their best interest to just delay it as long as possible and not make payments, because then they're going to wipe it out. So that person,
forgiveness program.
See, I'm getting over my head. That's not my pay grade. But I'm not a student loan expert. But I know the possibilities. Now, why and how you set it all up, I can't tell you all that stuff. But you can do a $0 income-based payment, and there are loan forgiveness programs. Who qualifies, how you qualify, I can't tell you that. I know doctors in certain programs that if they work in the hood, basically, for some million years.
Okay.
Sorry, underserved area.
You're talking about basically when you have student loan debt and you work in certain sectors for a certain period of time. I believe it's for like nonprofits. After a while, it will be forgiven or something like that. I'm aware of that. Okay.
Right.
I'm like, wait, I never heard of that. That's something that I need to get into.
Yeah, so it's certain things now. Like I said, can everybody do it? I don't know. But there are these different programs. It depends on probably what your degree is in and what field you work in or whatever. But anyway, so for the purposes of this, to answer your question, yes, if they go conventional, we can use the income-based payment. But like I said, you have to take it out of deferment, which means you have to start making some type of payment plan. It could still be zero, but it may be a payment as opposed to zero when it's in deferment. So we switch you to conventional, but conventional is stricter than FHA as far as credit score and debt to income ratio and all these different things. But that is a product that I have made work for those with the higher student loan debt. I had somebody that almost had almost $300,000 of student loan debt. So that really, it made all the difference. Like they were never gonna get approved for anything on FHA. So we switched them to conventional, and it worked for them. They got an income-based payment. Their payment was zero, and they were a doctor, an eye doctor, and they had almost $300,000 of student loan debt, and they had an income-based payment of zero. And so we did them conventional, and they were able to do everything they wouldn't have been able to do on FHA. So in this scenario, this person's going to have $25,000. Like I said, that's on the low end. But yeah, so for FHA, you have to count 1% of the total balance in your monthly debt. When you have an income-based payment of zero or whatever it is, then I can use that on conventional. But FHA, it does not matter. The minimum payment I can use is 1% of your student loan debt. So for this person with the $25,000, it's going to be $250. We'll get to that. So they got $25,000 student loan debt, credit card debt of $1,000, and they bought a car that was $25,000. So we're going to look at everything on a monthly basis.
Okay.
So we're going to see those numbers. So you have that. The next okay, cool. So like I said, the student loans, we're doing this for the purposes of FHA. just so you can see. So student loans would be 1% of that 250 with 225,000, which would be 250. And then the credit card debt will say that their minimum payment say is 100 on that $1,000 balance they got. Is that coming up? And then, the car payment thing. So the car payment on that $25,000 car is $500 a month, and then the credit card is $100. That's their minimum payment. Now, a lot of times when I say people, what's your minimum payment? They'll be like, I pay this, I pay that. Yeah, you might be putting more on it, but there's a minimum payment. That's what we use to calculate your debt to income ratio. Mm-hmm. So these are your monthly payments, right? So monthly debt is $250, $500, or $100, and your monthly income is $5,000. So remember how I was saying for the general calculation, you want to have be working with half of your monthly income, which would be $2,500. Mm-hmm. So we're gonna have, let me pull out my calculator. We're going to have, I already have my history. So we're gonna have $5,000, and we're gonna start subtracting off the monthly debts. Okay. So we got that $250. Subtract that. Oh, sorry, not $5,000. Sorry, $2,500.
$2,500.
Yeah, $2,500, which is 50% of your monthly income. So $2,500 minus that $250, minus the car note $500, and the credit card debt $100. So that's $1,650. So like, okay, what's that number? That is the maximum monthly payment that you can get approved for with this scenario. Okay, so based on that person's income and their debts, they can do, and this is at a 50% debt to income ratio. They can do this scenario, which is a $295,000 home with property taxes of $1,900. So that is a payment of $1,650. So it could be a different combination, of the purchase price and the property taxes, but that's just a sample, so you kind of get an idea of what does this $1,650 mean. So that's your maximum mortgage payment allowed with that scenario that we gave. Okay.
Right.
So
scenario.
Right. So then your question, like I said, what did you get? The question is whether they should get this car. Mm-hmm. So we want to look at it. What would it be if they didn't have that car? So they said, I had to get a car, right? I had to get this car, and now they got that $500 in there. But let's look at it if they didn't have that car. They would be able to go up to $2,150, right? And 500 back to that $1,650 a month. So that's their max payment. What does that equate to? That equates to $380,000 purchase price with the property tax of $3,000. That's a big, big difference. So if you get that car before you get the house, you're cutting yourself off at the knees, especially if you're a person that really, really wants to go to the high end of your, spectrum of what you could get approved for. So, or you had higher debts. So if you had some other debts going on in addition to that car, getting rid of that car and not having it would make all the difference. Because we actually put some debts that were kind of low. Like I said, most of the people I talked to that have student loan debts have more than that. They got, timeshares, high credit card debt, and lines of credit, and all these different things. So putting that car in there that you can't get rid of can really change what you can get pre-approved for. So remember, you scroll down to the next one. So that's showing there's a difference, right, of $85,000 having that car note in there. That's $85,000 less that you can get approved for. So, we just wanted to show you, so you can see, visualize, wow, I really want to wait to get that car if I can, especially, like I said, if you have high other debts that you can't get rid of, you don't want to add in something that you easily could have waited and did it later. So you want to try to do the purchase of the house before the car, because they give you a car, they hand you a car. You can have a $500,000 house and they'll still give you a car, and they don't do a debt to income ratio calculation. So they're going to come get that car if you don't pay it.
So one of the things that I actually just thought about, if you are in this situation and you're thinking about buying a car before you buy the house, I guess we would both agree that maybe you should wait until you get the house before you get a car. And I just had a inbox today. They said, but I need it for work. So there are a few options. Everything you do, I think you should do strategically. Okay,
Yes.
maybe you can go with like a car share, a Toro, right? Couldn't they run something on Toro?
Yes. I'm a Toro host. You rent my
Okay,
car.
there you go. These are Toro hosts. I use Toro in maybe 3, 4 different states. It's an awesome app, and it was a lot cheaper than going to Hurt or
Yeah, right.
Alamo, whatever.
Right,
So
right.
it's a great option. They have car share. The
Yes.
one in Philly is Zip Car, I believe.
Zipcar, yeah, I've heard of Zipcar.
Zip Car. So there are always options. Just try to think outside the box instead of just jumping the gun, because it's an $85,000 difference than what you get approved for. An $85,000 difference can be a difference than living in this zip code or that zip code.
Exactly.
Okay? So just be strategic about it. Be strategic about it. We got
Work to your trusty lender, your mortgage goddess, and we'll work out a plan of what you can try to afford. But like you said, that's a great idea. I didn't even think of that you just came up with of how to, stretch out that time to be able to buy the house before you get the car. Because I've had that problem where people are like, my car broke down, I need a car. And that's a great suggestion of all these temporary things to, that's not going to kill you, money wise, to just make it till you get that car, to get the house and then go get the car.
so can we go to slideshow?